Hello and welcome to Policy Watch, your one-stop show for the top business and economy news, its context, its relevance and impact. I'm Govindraj, Ethiraj. Today in this special report on Greece, we look at both the impact of the Greece factor on India's economy and its market and ask the fundamental question, is India vulnerable? Joining me to do that, Ambareesh Baliga, independent market expert, Gaurav Kapur, Royal Bank of Scotland, and later Nalin, Shah, director, NVS Brokerage Private Limited.
Greek citizens felt it hard Monday morning. Banks shut, capital controls implemented. Saving liquidity was the theme as the country stared at default and the end of bailouts by the European Union. Less money for people to spend and invest in business, the already weak economy lurched towards deep recession. As the deadline neared, despite last-ditch efforts, the writing was on the wall. Greece became the first developed nation to default on an IMF loan with no immediate bailout.
Είμαστε διατεθειμένοι να αποδεχτούμε και σκληρά μέτρα, τα έχουμε προτείνει άλλωστε, εφόσον το πλαίσιο μέσα στο οποίο θα ενταχθούν θα είναι βιώσιμο όσο αφορά το χρέος, όσο αφορά το αναπτυξιακό κομμάτι, για να μπορέσει να αποδηγιωθεί η Ελλάδα και το Brexit να φύγει από τη μέση. Να μην ξέρουμε ότι σε μερικούς μήνες θα είμαστε στο ίδιο.
There's no denying that the Greek economy is in tatters. In the third quarter of 2014, national debt was 176% of GDP. But Greece is not alone in Europe. Italy's national debt was 132% of its GDP, Portugal's 131%, Ireland's national debt stood at 115% of its GDP, followed by Belgium 108% and Cyprus 105%. Spain's national debt was 97% of its GDP during that time.
The entire business world in Greece today is practically frozen. Okay, there is no exchange being done in commerce or in trade or whatever. We are unable to buy or to sell something that will may cost 10 euros. Okay? Now, companies like this one or other type of companies will work for about 1 week or 2 weeks. Then will run out of cash.
If Greece does finally head out of the Eurozone, world leaders fear a contagion impact, as other European economies like Portugal are also seen as vulnerable to payment default. Emerging economies like India have also expressed fears of capital withdrawal. Krishnanand Tripathi's report for Rajya Sabha Television.
Well, the Greece economy is tottering and the rest of the world too is watching with bated breath. The tiny European nation has called for a referendum on July 5th on whether to stay or leave the Eurozone. Earlier, Greek Prime Minister Alexis Tsipras shut down banks for a week and imposed a daily ATM withdrawal limit of 60 euros. The moves have spooked world markets, including India. The larger question is, how vulnerable is India's economy to Greece-like shocks? Joining me to discuss that are Ambareesh Baliga, independent market expert, and Gaurav Kapur, economist at the Royal Bank of Scotland. Gaurav, let me begin with you. So, the simple question, how is it that a tiny nation in Europe has such an impact on the world economy and even a country as far as India?
Well, the fact that it's a part of a currency union, which itself, as a union is among, after the US economy, I think it's among the largest economies in the world. And the question really is that if it's not only about Greece, it's about the existence or it's about the monetary union, it's about the overall currency union and the Eurozone itself and its impact. And while Greece may be a small economy in terms of its contribution to the Eurozone GDP, which is about 2%, it's the size of its debt, which it now largely owes to official creditors than to private creditors, and its impact in turn on banks. And the health of and in turn the impact of that on, by the second derivative, on other, I would say, periphery economies within the Eurozone, which include large economies like Italy, which is the third largest bond market in the world. If you put all that together, I think markets are jittery because Euro was at one point in time being mooted as a significant, steady, credible alternative to the dollar.
Okay. Now, right. So, Ambareesh, let me get a quick feedback from you on this. So, the markets have been again jittery for a while now, and we saw considerable fallback in the last week, and then a recovery too. Just sum it up for us.
No, see, the initial fall in the markets was due to the question mark on monsoons and surely the question mark on Greece. The first 2 weeks we saw extremely good monsoons, because of which the market started rising up. And then there was always a hope that there will be a 11th hour sort of a solution for Greece. And that is what we are living with even as of today. We really don't know as to what would happen tomorrow, but even as of today, there is a hope that finally things will settle down as far as Greece is concerned. So because of which we have seen a very decent rally. I mean, on Monday, we fell close to about 8,200 levels. After that, again, it was a hope sort of a rally. So we have clawed back to levels of closer to 8,500, which is nearly the highest in the last 6 weeks.
Right. Right. So things are looking good, or better at least in the market. So let's come back to Greece, Gaurav. So what's the situation then? Is Greece obviously owes a lot of money to its lenders. Where do we stand today? Can it give back this money or can it not? And if it doesn't, what happens?
Well, it obviously can't. I mean, the government, in fact, IMF in its recent debt sustainability analysis of Greece says that the economy needs at least another 36 billion euros over the next 3 years, combined with the lengthening or elongation of the debt maturity from 20 to 40 years for the economy to kind of continue on the path of let's say on a steady state path and situation not to deteriorate any further. So it owes a significant amount of money to the Troika, which is the IMF, the ECB and the European Commission, and of course Germany, because
there's a $1.8 billion repayment that's coming up.
There is a see, they've already missed the $1.5 billion repayment to the IMF, which was due on 30th of June. The next, actually the big repayment is due on 20th of July of 3.2 billion euros to the ECB, and that's very crucial, because if they miss that, then the backstop or the liquidity arrangement which the ECB has been providing to the Greek banks to keep them afloat in terms of meeting their liquidity, day-to-day liquidity management, now that goes out of that becomes untenable.
So what could be the immediate impact? I mean, I know this has been discussed in detail in the past, but if we were to sum it up, what could be the immediate impact if the defaults were to happen in the manner that we fear?
Well, it depends on how, first of all, the referendum goes tomorrow. If there is a it's very difficult to call between a yes and no, because it's split right in the middle. Now, if there is a no vote, then the European leaders have, of key countries like Greece, France and Italy have made it quite clear that it's a referendum for the Greek voters on whether they want to stay in the Eurozone or not. Whereas the Greek government is kind of putting as a question whether they want to accept the bailout conditions given by the creditors. Now, if it is a no, then that is in that situation, I think Greece would want another round of discussion with the creditors. The creditors will have already kind of reached a situation they want. They've already kind of presented a certain package to Greece. Now, if in all, I think it's a fairly high chance that you will see a managed exit of Greece from the Eurozone.
Okay, so let's look at an exit and a non-exit, or a staying where things are. How does it affect India?
Well, either ways, I think it affects us through the confidence. First of all, the confidence route, because you will the initial reaction would be risk aversion among key foreign institutional investors. Money moving to safer havens like US treasuries or German bonds. But I think that is more of a short-term reaction, because India, actually having kind of survived the taper tantrum in 2013 and having done a significant amount of spade work in terms of putting first of all a firewall in terms of significantly sizable foreign exchange reserves, and secondly an environment where the central bank is credibly targeting inflation. Our external vulnerabilities come down significantly, especially looking at the current account deficit, and the overall hope that the Indian economy among the emerging markets remain the fastest growing economy, and the economies like China are clearly facing problems. So for India, for the short term, initially there will be a negative reaction, but it's quite clear that.
So let me ask you the more fundamental question, and let me put that one to Ambareesh as well. How vulnerable are we fundamentally?
Not very much. I mean, if you ask me what is the direct impact of Greece on India, I would say negligible.
Okay.
But the domino effect could be there, because if it's a no and it's a Greek exit, there will surely be turmoil in the Eurozone, and that will affect India. And first of all, you will have the institutions going on risk off, and that will affect the investment flow into India, at least in the short term.
Ambareesh, let me take a step backward. What I'm trying to understand is, how vulnerable are we fundamentally as an economy to global shocks like this?
I don't think
if Greece may blow over tomorrow for whatever reason, but are we vulnerable enough to be hit by the next one, whatever that
we will not be. I mean, if we have not been hit so hard in 2008, 2009, whatever said and done, it was a tertiary effect. It was not a direct effect on India. With Greece, I don't think that effect would be there at all.
Okay, Gaurav, so how do you say that? Because, I think what people are finally trying to understand, because no one can really put their arms around this whole problem of Greece, because it's such a tiny nation that it's really a domino impact that we're talking about and not a direct impact. So therefore, the more fundamental question is, are we fundamentally vulnerable? Are we likely to take hits if tomorrow similar situations were to develop?
I think we will definitely take some degree
and
of...
maybe the larger question is, to what extent are we linked with the global economy, or continue
to
be linked?
We are certainly fairly linked, far more linked than we realize, especially through the capital flow channel. And capital flows include all flows of various tenors, not only long-term FII flows, but you're looking at ECB flows, even trade credit. So we are, of course, it would definitely cause some degree of concern and some degree of pressure, which will pass through the market route, through the credit market route. You will see some impact on equities for sure. You will see some impact on the rupee in terms of downside pressure on the rupee. But I think we fundamentally, as I said earlier, we are in a far better place than we were. Let's say I would not go back to 2008-9. I think for us a more closer example is 2013. That's where we were really tested, and from that point on, I think we've. As I said earlier, I think
is that because we have very strong forex reserves, more than $350 billion?
A couple of other things, right? So besides forex reserves, our current account deficit, thanks to oil price correction, sharp oil price correction, and government measures to curtail fuel subsidies, has come down quite significantly. Our fiscal deficit is healthier than what it used to be. Our external debt is also fairly well financed. It's short-term debt. As a percentage, if I remember correctly, as a percentage of forex, I mean, our coverage is fairly good. So the impact would essentially come, and I think in terms of our exposure to Greece directly from exports or from, let's say from financing aspect, is actually quite small. I would think would be negligible.
But no, I think the larger question is now, what is our external strength?
External strength is, of course, Eurozone is a large trading partner, is a large export market, and our exports have been kind of dragging, and in the last couple of months we've seen export growth increasingly becoming negative. So that's a cause for concern. But other than that, I think the first instance we can manage through the kind of forex reserve pile we have, and post that, any which ways investors become more discerning once the initial reaction has happened, though I think it's very difficult for the markets to actually price in what may really happen once Greece exits, because you don't know if, we all know that the banking system is far more well prepared for it than it was in 2010. But then if one big institution ends up with some toxic assets, then we know what can happen, what happened in case of Lehman crisis.
Okay, Ambareesh, let me get a quick one from you here. So what's your sense? I mean, if, are we going to be permanently hit by such?
We will not be permanently hit, but short-term hit, surely yes. Because run up to this event, we have been hopeful that things will be fine, and because of which the markets have run up. So that's discounted. So in case it's a no and it's a Greek exit, then possibly we could have a decently sharp cut if you're talking of the next couple of weeks, next 1 or 2 months. Again, because of the domino effect.
Right. Okay, right. We need to take a break on this, but we'll be back. We're going to be back on the other side. We'll talk about the markets and their reaction to the Greek problem. And joining me then will be Ambareesh, who's right here with me. Stay with us. India's markets have recovered from the initial shock on a potential default by Greece to international lenders. The 30-share BSE Sensex gained 146 points or 0.53% at 28,092, and the Nifty rose 40 points or 0.47% to 8,484 on Friday as markets hope for a lesser impact of a referendum called by the Greek government. The larger question is, will Indian capital markets remain hostage to global developments like Greece? Joining me to discuss that are Ambareesh Baliga, independent market expert, and Nalin, Shah, Director, NVS Brokerage Private Limited. Gentlemen, thank you very much for joining us. So, Ambareesh, let me begin with you. Was this a surprise bounce back? I mean, we thought that it was going to be a one-way street downwards.
Absolutely. I think this was a surprise bounce back. Like I was saying earlier, there were two reasons for this bounce back. One was monsoons, which was better than expected. We were expecting a dry June. It was nearly, I think, 30% higher than normal. And then because of the hopes that finally you'll have some sort of a solution on Greece, and because of which we saw this bounce back in the last 1 week.
Okay. Nalin, what we are trying to understand is how vulnerable are Indian capital markets to global shocks? And what is the kind of symptom or the disease that we are witnessing currently?
I would say that Indian markets could, have direct impact will be minimal or no impact, I would say. But it could be having, a couple of, I would say, side effects from which Indian markets can get spooked or, have some kind of a correction phase. One is that it could be, the psychological and sentimental, sell-off if there is a risk of kind of a scenario. And in that scenario, if there is a heavier pressure from the FII circle, because they have been the continuously sellers, in that case, if there, today even mutual funds and the DIIs are supporting the market in a big way, and that's why we are not seeing much fall in the market. But if there was a larger pressure, there could be a one risk of phase where one can see some more pressure on the market.
Okay.
Secondly, I think based on if the Greece default, if the interest rates in the euro region rises, particularly on the bonds by Italian or Spain or some other economies, if the interest rates rise, in which case dollar is becoming stronger. And in that case, if the rupee weakens, there could be, some more effect because of the rupee declining.
Right.
So these two, I feel that could be the most important factor. Other than this, I don't think that there is going to be any direct impact on the Indian markets.
Okay. So let's now look at the Indian markets, Ambareesh.
Right.
Why are they so vulnerable at this point? I mean, a vulnerability is also a result of internal weakness.
Yes. Vulnerability, one, in case something goes wrong in Greece, the domino effect, and because of which possibly the FIs could pull out.
Right. And FIs, of course, account for a large part of the trading.
And in fact, they have done that in the last 3 or 4 months, and we have seen the effect. But once the Greece issue is over, whether yes or no, it is going to be the local domestic issues which will come to fore. First of all, again, monsoons, because again it's expected that July, August and possibly September could be drier than what we are expecting as of now.
Whose forecast are you going with?
I'm going with IMD still.
Okay.
Because they've been there much longer than the others in India. Number 2, earnings. I don't think even this time there would be any surprises. We have seen pathetic earnings for the last quarter. Even this quarter is going to be no different. Number 3, I think the political heat is increasing after a very long time, and there is a possibility that the monsoon session could be a washout. So I think these are a couple of reasons.
And you're saying that some of the transmission of some of those bills may not happen.
Absolutely.
Okay.
And because of which there could be pressure on the market going ahead. So even if Greece is yes, we could see an initial bounce. But again, the question is whether that can sustain or not.
Right. So, Nalin, how do you are you in concurrence with Ambareesh? I mean, weak second quarter numbers.
Yes, I think
likelihood that bills may not pass.
That's right. April-June quarter is going to be, I think, the weak quarter. That I think everybody is a foregone conclusion. So the bounce back is more, I would say, that sympathetic, in the sense that you had a big fall from almost about 30,000 to 26,300 kind of a levels on Sensex, and that why there was a markets were oversold. So some bounce back was expected, and that is what exactly has happened. But if the Greece problem is not resolved, or even if it is resolved, but then I don't see any real I would say positive impact that how can Greece problem be resolved, because there are huge burden of debt which this country is unable to. Even the latest IMF report has said that there has to be write-off which has to be taken by the lenders.
Someone wants to take a haircut.
Right. So then only the Greece problem will in future get resolved. So what we expect that, coupled with the now delay, somewhat delay in the furtherance of the monsoon, then weak results. And I think again I would say that since market has already jumped by 2,000 points, there has to be the correction phase in the market which will go on. And generally speaking, the technicals of the market have been very strong in terms of very optimistic kind of expectations from the new government. But fundamentals continue to remain weak. It is going to be reflected probably by the end of this calendar year or early next year. And that is why we do expect that some correction phase in the market will go on and prolong it.
Right. So Ambareesh, how are you seeing fund flows? I mean, we know what the foreign fund flows are looking like or not looking like. What about domestic? I mean, do you see
domestic fund flow surprisingly is extremely robust, and this is thanks to the retail investment flowing to the mutual funds via the SIP route, and that's becoming stronger and stronger. And I think for the first time, the sort of flows which have come to the mutual funds and their investments are in fact more than making up for the FI outflow, which we saw in the last couple of months. So that's one, I think, like quite a positive sort of a development for the Indian markets. The other one possibly could be the sort of IPO flows which will be there over the next couple of months. And historically, we have seen that whenever there are mega IPOs coming in, the markets have held on. So I think these two could be the positive, sort of triggers.
But are you seeing mega IPOs of the kind that you're referring to?
I mean, if you add up all these IPOs which will be coming.
No, in terms of the quality and the expectation from the markets?
Quality, again, you have Ratnakar Bank, RBL, you have a Cafe Coffee Day, you have a Indigo. I mean, if you add up all these IPOs.
So you're saying that sort of blue chips or
absolutely
likely blue chips?
Yes.
Which are,
Yes. So I think because of that, the markets could possibly hold on. That could be one of the reasons why the markets could hold on. So I'm giving you both the sides.
Okay. So supply and demand. So let's look at Qs, right? So we were talking about weak second quarter earnings, Naveen. So what's your sense going forward? Now, if this quarter is going to be weak, is there any real support for the markets then? It seems to be driven more by a combination of flows and technicals and sentiment and so on.
Yes, I think the flow of the retail investment into the mutual fund equity schemes is steadily increasing. The AUM
so
has
that's the
increased
flow of
overall,
money, right?
and
So
that
that's
is
the
why
supply,
because they need to invest, and
right.
that is why you are seeing a good support. If you know, and when there is a, I would say that less the flow stops or flow reduces, and the FII selling pressure continues, then we may see suddenly there is a gap in the market, and
right.
that is why.
So what about fundamentals themselves? What's the market's perception of when fundamentals could improve? So if you're saying second quarter is already washout is a foregone conclusion,
that's right.
Then are you looking at a third quarter now? Or?
No, I would say that April June quarter, by the time the results will be completed, result season will be over, more or less you are going to be in the middle of August. By then the market will also see, one is the weaker results, market will also by then have some fairly good idea about the progress of the monsoon. Thereafter the market will take its own cue. But real, I would say that the market consolidation could really occur only after, I would say that sometimes October or November.
Okay, so you're
because
looking at
again September one is looking to some kind of a raise in the interest rates in US. If that also is playing its part, then one could see that again the markets get spooked.
Okay, so Ambareesh, what's the next set of cues that you're looking at to?
Next set of cues, I think, we need to see as to how much the government spending happens in the infrastructure sector. I think that's the first one to take off, and we've been waiting for it for quite a while. Now, unless that does not happen in the next 3 or 4 months, then I think we need to forget about all this story which we've been talking of in the last
let me put it differently. What could bring about a stronger third quarter, which in turn might have
it has
positive impact on
it has to be government spending. It has to be decent monsoons, better than what IMD is talking of. If these two things happen, and at the same time you have all these policy measures being taken, then I think you can expect a December quarter earnings could be better than what we've been seeing in the last 2-3 quarters, and that will be the trigger.
Right. So in the meanwhile, yes, but does that also mean that we will continue to be vulnerable?
I think, can I add this thing? That what I think Ambareesh said is very right, and add to that, I would say that there are reports that the infra sector is witnessing some kind of a stalled projects, are witnessing the reduction in the stalled project. That means that stalled projects are getting into the action mode now. If that continues in a little larger way and starts contributing to the overall, I would say that activity in the economy, that could pave the way also for the rejuvenation of the industries like maybe cement, construction, and that is all post monsoon. And that's why I feel that October onwards, probably the markets may start consolidating in the expectation of that the December onwards results could be better.
Right. So even as markets stand today, what are the bright sectors that you're looking at and the not so bright at this point of time, Naveen? And then I'll ask Ambareesh.
Yeah, I would say that I am looking to the bright sector. Of course, the banking and finance continues to be the brightest sector. I would also feel that the cement sector appears to be quite good. Even construction sector
today, or is it likely?
No, it is likely because based on the what we were discussing, and I understand that overall in the I would say that Indian scenario, the cement prices are, I think, able to maintain, the producers are able to maintain. And going forward, I think, it's a more like psychological factor along with the fundamentals which will play catch up. So, today we are in the range of 26,000 to 29,000 kind of a range. Either way, once we break out from one way, then the things will start improving.
Ambareesh, what are your picks?
I mean, the sector wise,
Yeah.
clearly power ancillary. I mean, they are the ones who've been getting orders, and I think they are the only ones who are actually happy about the sort of order flows which they've seen in the last 4-5 months. And if you look at the IIP data, they are the ones which have been showing month on month sort of a increase. So that's one sector which is doing extremely well. Power ancillaries, not power. But then at the same time, I would be slightly bullish on the infra space because that's one space which has to take off first if India has to achieve that 8.5–9% sort of a growth which Mr. Modi has been talking of. And at the same time, since the balance sheets are stretched, I think there will be some amount of repairing of balance sheets happening. We have already seen that to a certain extent with some of the companies. The next sector could be power because end of the day, without power, you cannot have Make in India.
Right. So either way, you're only looking at the big players.
Absolutely.
Largely.
And I would say automobile could be a good beneficiary because it appears to me that companies like
the sector
Tata
is still
Motors
operating at very low capacity.
Automobile.
Yes.
Yeah, but you see, what we are seeing is that Tata Motors, for example, one of the top player in the utility sector, the numbers are improving, and that's a good sign, I would say.
Okay, so good. I think so. We've got a few sectors. We are saying that overall things are weak in India, but our ability to withstand shocks is not as bad as some of us might believe.
Absolutely.
Right. So we are quite strong there. That's a good note to end on. Thank you so much. We've run out of time. We'll be back next week, same time. Thanks for watching.